Let's welcome our much-awaited guest, Jaspal Bindra, Executive Chairman of Centrum Group, who has joined us, and a veteran banker, actually, a long stint at Standard Chartered before this. Good morning, Mr. Bindra. Thank you very much for joining us. The pain point for the market is the NBFC and HFC sector. And considering your knowledge of both banks and non-banks, we thought you would be best placed to tell us how you view the sector. Do you expect that there is going to be a contagion, a probable default, and therefore systemic pain?
So, Lata, it depends on a couple of factors, but I think some of it is becoming more obvious now. There are two big causes for the pain. One is the mismatch between the asset liabilities, and the second is the quality of the asset book. And I think we have concerns on both fronts. There are obviously, I would put all the NBFC and HFCs into three categories. One that will shrink, one that will exit, and one that will have slow to flat growth.
Okay, not ones that are good and grow, no?
So it will be slow growth. I can't see anybody sort of going very fast in this space.
Okay, well, Bajaj Finance said 35% over the next 3 years, CAGR. So, well, I was just wondering if you thought some people can be outstanding. But yes, Sonia.
Yeah, Mr. Bindra, good morning. We'll come to growth in a bit. You know, over there, of course, there's a prediction of a slowdown. But to avoid a recurrence of the current turmoil in the NBFC space, what steps do you think the RBI should take?
I mean, it's difficult for me to speak on behalf of what the RBI should be doing, but I think there is need for some discipline on asset liability match because that has, you know, in the effort to maximize margins, people have been sort of short-sighted on going for the cheapest source of funding. And having been a banker for 3 decades, I mean, one will appreciate that asset liability matching is probably the most critical factor for sustainable growth of a company. The second issue is really on asset quality.
Go ahead, sorry.
Which I think the compromise has come. The compromise has come because of these very high valuations. There was a big rush to grow the book. And I think that is no different to what the banks have done in the past and now the NBFCs are doing.
Irrational exuberance is what we called it, right? Mr. Bindra, do you think the situation is going to come to a point where the Reserve Bank may have to give some kind of financing to mutual funds? I am not able to see how they can ever give financing to NBFCs because the Reserve Bank needs government bond collateral. But could it, is that a way out to give a line of credit to mutual funds so that if they are faced with redemptions, they have a fallback?
I think there is a two-step process here, Lata. There is one is, yes, there's been redemptions in mutual funds, so they don't have sufficient liquidity. But the second, equally important, is the appetite for NBFC risk now has clearly reduced both for the banks and possibly for mutual funds going forward as well. So as you've seen, the recent RBI increase in limits per NBFC for non-infra NBFCs increase from 10 to 15% has come out to be meaningless because people are not worried about the limit. They're just not interested in having more exposure.
Okay. So what is your view of the end game? In terms of time and in terms of impact on the stock markets?
So I think it is very likely, the most likely route that I believe is possible at the current point and which the RBI should encourage is for banks to provide liquidity to NBFCs through picking up portfolios. I think some of that has started and hopefully there'll be more of that. And then maybe, you know, there would be a point of the NBFCs deploying the next round of liquidity they get from those sales in better both better quality assets, but also better financing sources as well.
Okay. Just coming back to the first point you made about growth slowing down, as capital raising becomes a bit more expensive and the increased cost is perhaps passed on to the borrower, how much lower do you think growth could be, say, over the next 1 to 2 years for the industry as a whole?
Well, if you just go by what happened in the last few weeks, most of the big houses have, NBFCs I'm speaking about, have closed shop. They have not even been lending at all. So I assume they will resume that lending very soon, but it is going to be at a very calibrated and moderate pace. So just given that growth in AUMs being more limited, the return is likely to be very much lower compared to previous period.
Okay. Well, we will have to leave it at that, Mr. Bindra. Okay, let me ask you one quick question and take liberty from the next show. If you have to compare it to the 2002-2003 run on NBFCs, is this worse because they are larger, or is this not as bad because the rules are better?
I think it's different from, I don't think so they're comparable in the sense, I mean, NBFCs are a much more meaningful, as a sector, is far more meaningful today than it was at that point in time. And so systemically, it's more relevant than it was then. But I think it's all about, individual players. I don't think so we should paint a broad brush. At Centrum, we have no panic. We have no short-term borrowing. We are able to pass, all our pricing is variable, so we are able to pass on the expensive incremental cost of borrowing to the borrower, which is happy to absorb. So
have any
I think
real
it's
estate
business
loans?
as usual for some.
You have real estate loans?
No, not yet. We do mortgage loans, but no builder loans.
Oh, okay.
We have an affordable housing book.
All right. We'll leave it at that, Mr. Bindra. Thank you very much indeed for joining us with your thoughts this morning, especially on the two markets, the debt and equity markets. We leave the equity markets in much better shape as we wind down on Bazaar. It's 3 stocks in the red for 2 in the green, so not a bad ratio at all considering where we began. Thanks for watching Bazaar. Chartbusters up next.